Okay, so for chapter 9, we're going to talk about the concept of budgeting, and so we're going to begin with the master budget. Okay, so for the first objective number 1, we're going to talk about describing how and why managers use budgets. First of all, the concept of a budget is really a plan, and think of a financial plan in terms of what we're going to be doing in chapter 9, and we're going to be looking for a specific period of time. Generally speaking, usually 12 months or less. You can go beyond 12 months, but typically the problems we're going to be getting into for planning for future, typically it's anywhere from 1 month to up to, let's say, 12 months in advance. And what this is going to allow you to do is basically to help you determine how to use resources. We're going to go back and look at all of our different types of product cost and period cost. It helps us plan our cash flows. It helps us look at future costs. It also helps us look at our future planning for revenues. And this could have a big impact on where you can take the company. But again, the idea is if you have a plan, you're most likely going to be more successful in the outcomes. So typically you may come across the concept of what they call a rolling budget. And again, it's basically planning, always planning ahead for the next year, for the next 12 months. You're always going back and looking at your budgets and making adjustments in terms of what you plan versus what has actually happened. So just remember, the budget is the plan, and you're always going to be comparing the budget eventually to the actual results, but you're always continuously updating based on what's happening either in industry or also within the company. Now, the concept of participative budgeting, if you think about it, the more you can involve management, you're going to get more buy-in and it's going to be more successful in terms of the outcomes. So typically, you do not want a top-down type of style where you're just pushing all your ideas and you're not asking for thoughts and feedback. So the best types of budgeting is where you allow your middle management and even some of the lower management to actually get involved and have some ideas and thoughts and keep them up to date. So you're going to get more buy-in in terms of success with your budgets. And obviously the benefits to this, again, if you involve somebody's going to take ownership of their idea, and if you can put in some rewards along with achieving certain levels of success, it's basically going to grow the company. Sometimes there could be some problems. Again, if you don't involve lower management, you could get negative feedback, and if you get negative feedback, that means you're not going to meet your production needs. Sometimes if you set unrealistic budgets, we'll talk about that later, unrealistic budgets where basically the standards are so high that you can't achieve the results, the budget's not going to really do any good. So the concept is you want to try to save money, increase revenues, have good cash flows, and so a good plan is going to take you a long way to being a successful organization. So typically when you're first getting started, or you're trying to look ahead for the next period's budget, is you want to look at either the prior year's activity or maybe the last couple years, last 5 years averages, and also look at what's happening right now in your company when you start actually developing these. And so you're not going to actually have to do a lot of that in this chapter. They're going to have you set up some budgets. They're going to give you all the data. But realistically, how do you do a budget? How do you know what's going to happen next year? Obviously, look at last year or look at the year before, and then you can start to make some predictions on what's going to happen in the future. So again, like I said before, the benefits of budgeting is it basically sets up a plan. If you have a plan, you're going to follow that plan, you're going to be more successful. It also promotes communication. It forces everybody to communicate if you're going to achieve those. And the concept of benchmarking, where you set standards, we'll get to that later, it's going to actually help you evaluate performance. It's going to help you become more efficient, save money, which is all good stuff for the company. Okay, so the master budget is typically the starting point. It's a comprehensive plan for the whole company. We're going to have basically several budgets or schedules that are going to be linked to basically sales. That's what they call the supporting budgets. But everything's going to be tied into the master budget, and you'll see in a moment how all these budgets and schedules are essentially linked together. Okay, so here's a picture of your master budget. Notice the starting point at the top is your sales budget. Your sales budget then is linked to the production. So production is based on sales. And then based on production, notice if you kind of follow your 3 product costs, notice you've got a direct materials budget. That's product cost number 1 we've been talking about all semester. We've got a direct labor budget, which is product cost number 2. And then notice product cost number 3, which is your overhead budget. All of those are tied into the production budget. And then of course, if you keep going, and then once you've gotten this out of the way, then of course you can look at what they call your operating expenses budget. And just to kind of remind you, that's essentially your period cost. That's your general selling and admin. And then once you get all this tied together, you could do a budgeted income statement, you could do a budgeted balance sheet, and you could also do a cash flow budget in terms of looking at cash coming in and cash coming out. It helps you plan your cash flow in case you need to borrow money from a bank. But notice everything here is always linked together. They're all related. And just remember that the starting point at the very top is your sales. So then notice again, as we continue from the previous slide, once you can get your budgeted income statement, notice you've got capital expenditures. That's your fixed assets. That's like buying equipment and big purchase type of items. You've got the cash budget, which basically looks at cash inflow and cash outflow. And then you can also do what they call a budgeted balance sheet. Just like you have a budgeted income statement, you can do a budgeted balance sheet. Okay, so for objective number 2, we're going to go through and look at how to prepare the operating budgets. Okay, so for the first one, we'll start with the sales budget. So this one's a pretty easy one to actually calculate. All you do is you're going to take your number of unit sales, you're going to multiply that by your sales price per unit, and that's going to give you your total sales revenue. Now, we're going to think simplistically in this chapter because, you know, lots of times companies can have multiple different types of products. Most of the problems we're going to look at, think of a singular product, you know, it's just to give you the idea. And so we'll have essentially a constant unit sales price, and the number of units we're selling is essentially the same type of product. So notice this schedule, this is Exhibit 9-5. This is a sales budget for the quarter ended March 31st. That means January, February, March. So notice we've got here's January, February, March, and then they've summarized it in this column. Notice here's your unit sales. You've got the sales price, which is $20 per case. You multiply these, so 30,000 times 20 gives you 600,000 of sales revenue. And then for February, it'd be 20,000 times 20 gives you $400,000 of sales revenue. And you can go on and on and on. Pretty simple calculation. Just take your unit sales times the sales price. So this total sales revenue, that's your budgeted revenue. And then down below, notice how they're breaking this apart. They're telling you based on past history of their sales, 20% of their sales are typically cash and 80% are credit. Now, the reason you're going to want to know that is because later on when you start to do your cash budget and you start to predict how much cash flow will come in based on these current revenues, you'll need to know this mix because you'll have to do some planning in terms of when do those credit sales get collected. Okay, so let's look at this illustration. This is S9-3. We've got Duke Sports Medicine. They have 2 types of physical exams for students. They call the basic and then the extended physical. They charge for the basic $105. They charge for the extended, they charge $160. So here's our 2 sales prices. And then down below, keep reading, they're going to give you how many physicals they expect to perform on each type. So for example, they expect 240 basic and 170 extended in July, 250 basic, 230 extended in August, and then 75 basic and 90 extended in September. And they want you to do, here's the requirements right here, prepare the sales budget for the second quarter. So that's basically July, August, September. And then in the next slide, we'll show you how to you simply calculate your projected revenue based on these numbers. So as you can see, we've got July, August, September. Notice we've got 2 categories. We've got the basic here, and then here is the extended. And so for the basic, here's your 240, 250, 75. Simply multiply that by the sales price, what you're going to charge. So you got total sales revenue for this type of physical, for example, for July, is $25,200. So then when you look at the extended physical, they're going to do 170 of these times the sales price of $160. You're going to get $27,200 from that type of physical. So what you do for July is simply add the $25,200 plus the $27,200, and that would give you the total sales revenue projection for the month of July. And you can do that for each of these months. And then you'll notice they also summarized it for the quarter. Okay, so then the next schedule or operating budget is called the production budget. And just kind of make a note, remember your production budget is based on sales. So think of this as a formula that you're going to use where you take your unit sales, you're going to add, this is the formula, you're going to add your desired ending inventory, because remember production is finished goods, equals total units needed And then you're going to subtract out the beginning inventory. That's going to tell you your what we call your required production. So in the next couple of slides, we'll walk you through some examples on how to calculate it. Okay, so notice for this particular example of a production budget, they give you January, February, March. Notice here is that inventory formula in a vertical format where they give you units of sales. They give you the desired ending inventory equals total needed. Then you subtract out beginning inventory. Now, when you see this 10% up here, if you read this down below, it says management wants to maintain an ending inventory equal to 10% of next month's projected sales. Now, basically, this is the formula you need for ending inventory. So, for example, if you are in July and you have 30,000 unit sales projected, and then you look at February as 20,000, to get the desired ending inventory for the month of July, you'd have to take 10% and multiply that by the next month's sales, which is 20,000. So 10% times 20,000 would give you 2,000. 30,000 plus 2,000 gives you 32,000. Then, of course, to get the beginning inventory, your beginning inventory would be 10% of the current month. So 10% of 30,000, okay, that would give you 3,000. You're going to subtract that, and that's going to give you your required production for January. Same thing in February. If you wanted to get the ending inventory for February, you'd take 10% of March's, which is 25,000 times 10%, so that's where they get the 2,500. You add that to 20, you get 22,500. Notice the beginning inventory is the 10% of February's, which is 20,000 times 10%. There's your 2,000. You would subtract that, and then you get 20,500 as your projected units to produce for the month of February. So again, think of the production budget. You're going to need to be very familiar with this formula, and every problem that you work, they're always going to give you what management desires for ending inventory, whether it's 10% or some other number. Look for this type of number in most of the problems, and that's how you're going to put together your production budget. Okay, so let's look at 9-4. We've got Trader Cycles makes chainless bicycles. On March 31st, it said they had 220 bicycles in inventory. The company has a policy that ending inventory in any month must be, here's the formula, 30% of the following month's expected sales. Trader Sales expects to sell the following number of bikes in each of the next 4 months. So essentially, this is your sales budget right here in units, and we're going to put together a production budget for the second quarter. So again, remember the formula. We're going to take essentially our sales. We're going to add in our desired ending inventory. Write this right here. And that desired ending inventory, we're going to use that 30%. You add that, that's going to be your total needs. And then you subtract out your beginning inventory, and that'll be the number we're going to come up with. That's going to be our required production. And again, on the next slide, I'll walk you through the exact calculations. Okay, so notice we've got April, May, June. These numbers are given again in the problem. And again, to get desired ending inventory for April, you're going to need to take the 30%, multiply that by 1,180. That's going to give you 354. You're then going to add that to 1,000. That gives you 1,354. The problem already gave you beginning inventory. They put this number in the problem. So you subtract out 220, and then the final answer for the month of April would be 1,134. Let's look at May. For May, to get the desired ending inventory, again, you take 30% of June, which is 396. You're going to add that to 1,180. That gives you 1,576. You then subtract out the beginning inventory. Remember, beginning inventory will be that 30% of 1,180, which is 354, which would give you the desired production for the month of May to be 1,222. Okay, so the next schedule we're going to look at is the direct materials budget. So notice again, the starting point is your production budget. And look at, here's the same formula that we just used for production. You're going to add in some sort of desired ending inventory. Again, the problem will give you what that needs to be. That's going to equal the total quantity needed. You then subtract out beginning inventory to get how many raw materials you need to purchase. So here's an illustration, Exhibit 9-7. Notice in this case we've got January, February, March. Look at the starting point. You've got your production budget given at 29,000, 20,005, 25,7, and so forth. And then notice they're making you do a conversion. Every problem will tell you something where it'll tell you how many pounds or kilograms or how many parts of the raw material goes into each product. And in this case, it's going to be 5 pounds of direct materials per unit. So what they first have you do is they have you multiply it by the conversion of 5. That tells you how many total pounds. So if you take 29,000 times 5, that gives you 145,000. If you take 20,500 times 5, that's going to give you 102,500. So then once you do this conversion, which typically you always have to do this part first, then notice this formula is essentially the same that you would have done for the production budget. You add in some sort of desired ending inventory, that equals total needed, subtract out beginning inventory, that tells you how much you need to purchase, and then the problem should tell you the actual cost as well. So if you look down here at the bottom, they tell you what they want ending inventory to be, which is 10% of the next month's production needs. So the way you get this is, so if I'm right up here at the top, I got 145,000. To get my desired ending inventory, I'm going to take 10% of February's production needs, which is 102.5. That's going to give me 10,250. You then add that to 145,000. That gives you 155,250. You subtract out 14,500. And remember, the 14,500 could also be obtained by simply taking, in this case, take 10% of 145,000. There's your beginning. You subtract that. So right here, the 147.50 is what you need to purchase. The cost per pound is $1.50, so you multiply that by $1.50, and so your total cost would be $211,125. Look at February. Again, we've already converted it, so we got 102.5 as our starting point. That's your production needs. To get your desired ending, you look at March's. So you take 10% of 128.5, that's 12,850. You add that to your production needs for February. That gives you 115,350. You subtract out the beginning. Remember, the beginning will be the 10% of the 102.5. You get a total purchase needs of 105.1. Multiply that by your cost. Last line here, last row, gives you your total cost for the month of February. Now let's look at this illustration. We've got the bakery by the bay produces organic bread sold by the loaf. It says each loaf requires 1/2 pound of flour. So we're going to have to do a conversion with this number to do the actual materials. We need to know how much materials goes in to each loaf. So this says 1/2 pound. We'll need to know that. It says the bakery pays $2 per pound of organic flour. And then here's our production. So think of these numbers right here. That's essentially your production budget. And then down here at the bottom, they're going to tell you your inventory needs. It says the baker has a policy that it will have 10% of the following month's flour needs on hand. So we'll need that 10% to calculate ending inventory. And then they go ahead and give you at the end of June how much was on hand. They want a direct material budget for the third quarter. And then in the next slide, I'll walk you through the calculations. So notice we've got July, August, September. These numbers were already given to you. These are your production numbers. Notice the first thing you have to do for your direct materials is you have to multiply by 1/2 because it's 1/2 pound of flour per unit, which essentially is 50%. So if you take 50% or 1/2 of 1460, that gives you your total needs for July, and you can do the same thing for August, September. So then once you do that, notice our formula. Here's our inventory formula. So to add desired ending inventory to get 96, you're essentially going to be taking 10% of 960. That's the next month. That gives you 96. You add that to 730. That gives you 826. The problem already told you on hand was 100. They told you that number. You subtract that. You get how much you need to purchase, which is 726. Multiply by your cost per pound, 2. Total cost, 1,452. Look at August. We took the 1,920 times the 1/2 pound. We got that converted. So we got 960. To get your desired ending inventory, you have to look at September. So take 10% of that number. That gives you 88. You're going to add that to 960. You get 1,048. You subtract out your beginning. Now remember, your beginning is that 10% of August, which is 96. And then you get 952. That's how much you need to purchase. Multiply by the price per pound. This would be your total cost expected for the month of August on direct materials. Okay, so the next schedule is going to be our direct labor budget. Again, notice the starting point is your production budget. You're going to multiply by some sort of standard, how many hours, for example, it takes to make 1 unit. Again, this will be given in the problem. Once you multiply that out, that tells you how many labor hours you need. And of course, the labor cost, how much do your employees make? Is it per hour or some other cost? Again, that will be given. And then at that point, that's going to give you your total direct labor cost. So look at this illustration. Notice again, the starting point is production. We've got January, February, March, same numbers. They tell you here you multiply direct labor hours per unit, which is 0.05. So essentially, they would have had to have told you somewhere in a problem that it takes 0.05 hours to make a unit, for example. So once you know that, you multiply by your production units. That tells you how many hours are required. You multiply that by the labor rate, which in this case is 22. You're going to get 31,900. That would be your total labor cost for January. And then you basically do the same process for all the months. Take the production units, multiply by how many hours it takes to make a unit. Essentially, the 0.05 is a standard. And then you just do that, and then you multiply by the labor cost. That's going to be essentially your payroll. So let's look at 9-6, where we've got the production department of Cameron Manufacturing. They have prepared the following schedule of units to be produced over the first quarter. So think of your starting point here, guys. These are your production units. Notice they tell you right away, it says each unit requires 6 hours of direct labor. So this is your standard. They have to give you that. They pay their workers about 16 bucks per hour. Again, we'll use that. And then we're going to come up with, again, our budgeted labor for January, February, and March. We'll show you that in the next slide. All right, so here we go. Here's the numbers. Again, the top row was given to you simply. Here's your 560, 600, and 860 production units for January, February, March. They told you it takes 6 hours to make a unit. So for all of these, you're going to have to multiply them by 6. That's going to tell you how many hours are needed for each month. So for January, it's going to be 3,360. You then multiply by the average labor cost. So you would expect about $53,760 of total labor cost for January. You do the same thing for February, March. Pretty simple calculation. You know, if you were doing this on the job, you just tweak a couple numbers, you'd plug these into your spreadsheet, and your spreadsheet would kick out the numbers almost instantly. Okay, the third one, again, think of this as your third product cost, is your overhead budget. Notice on this one, again, the starting point is your production, just like the other ones, but also notice they're very detailed in how they're putting this one together. And when I say detailed, they're actually going to split out your overhead between the variable overhead and the fixed overhead, because remember, your variable overhead behave in accordance with production volume, whereas your fixed overhead, remember, a total fixed cost is simply going to be fixed. It's not going to, you're not going to worry about your volume on fixed. So every time you see an overhead budget, you're going to have two basic categories. You're going to have variable overhead and fixed overhead. Typically, your fixed overhead, again, they're just going to tell you all these numbers in a problem. You just have to put them in the right columns. For your variable overhead, you have to do some multiplying. And for example, in this case, it says variable manufacturing overhead costs. You have indirect materials, $1.25 per case. So what you'd have to do is multiply $1.25 times 29,000. That would give you the 36,250. For indirect labor, if it's 75 cents per case, again, multiply by 29,000. That's going to give you the 20,750 and so forth. So with your variable costs, you'll have to multiply by your production units, and that's going to give you your total variable. So for the month of January, it would have been 72.5. All your fixed cost would have been given as well. Your total fixed is 30,000. You're going to combine the variable and the fixed, and your total budgeted overhead for the month of January would be 102,500. And you just do the same process essentially for each month. Okay, so look at illustration or problems 9-7. We're going to do an overhead budget. Notice in this case, they start with direct labor on this one because your variable overhead is going to be based on direct labor. So they went ahead and gave you budgeted direct labor hours. We'll need that. And notice they tell you that the company's fixed overhead is $3,000 per month. They want to know, for example, how much manufacturing overhead will be budgeted for April, May, and June, and for the quarter. We'll do this on the next slide. Okay, so to get the variable overhead, notice they didn't give you the production numbers, but just kind of remember that even though they did not start off with production on this, that these budgeted direct labor hours would have been based on production. So on this problem, they just said, okay, start with budgeted direct labor hours because our variable overhead is based on the labor hours. So they give you the 490, 770, 660, and then they tell you that it costs $1.60 per direct labor hour. So you just simply multiply these by your budgeted labor hours. You would get your total variable overhead for each month, and then they just simply told you that your fixed overhead was $3,000 per month. You just add in your fixed, and then at the bottom that's going to give you your total overhead, and you can do that again for each month. All right, now the next budget or schedule is the operating expense. Think of this one as all of your period types of expenses, your general, selling, and admin. And notice it's similar in a way to the overhead budget, where they're going to break this thing apart by looking at your variable operating and your fixed operating. And if you look at the categories in this example, look at, you've got sales commissions, shipping, bad debts expense for variable. For the fixed, you've got salaries, office rent, depreciation, advertising. Again, everything on this schedule, it's not production, it's your period cost. Again, it's your general, selling, and admin. And the calculations are pretty simple. They have to give you all these in the problem. But notice on this one, your variable costs are going to be based on your units sold. And so to get all of these variable expenses, they give you the amounts here. For example, for your commissions, it's $1.50 per case sold. You simply have to multiply all of these by 30,000. They give you the cost per case. And then once you do that, that's going to add those up. That's going to give you your total variable operating. And then for your fixed, all these fixed numbers, they're just going to tell you salaries, office rent, depreciation. They're just going to give them to you. You just have to add them together. You get total fixed. And then you're going to combine the variable and the fixed to get your total for each quarter or each month. And also you can do it for each quarter. All right, so to give you a simple example, this is 9-8. They want an operating expense budget for the upcoming quarter. Notice they already have given you the budgeted unit sales. They tell you that the variable operating is $6 per unit. And then notice they go on to give you the fixed. Here's your fixed cost. They give you salaries, rent, depreciation. And then now we can put together our budgeted operating for this quarter. All right, so here's the data. Again, the top row, they had given you all the budgeted unit sales. They told you that the variable cost per unit was 6, so you just simply multiply by 6. I'm just looking at, for example, at July. You get total variable of $7,260. Notice all these fixed costs were simply given. You just have to add those together. That gives you $10,006. If you combine the variable and the fixed, that's going to give you the bottom total overall operating for each month. For July, it happens to be $17,860. Okay, so now once you put together all of your product costs, remember we just did a direct material, direct labor, and overhead budget, you can then project what your actual budgeted cost per unit is. So if you go back, you can kind of look at some of the previous slides where you could have figured out, for example, here's your product cost number 1, direct materials. It was 5 pounds per case at $1.50 per pound. Direct labor, that's product cost number 2. Remember, it was 0.05 hours per case. It was $22 per hour, so you could get your labor cost. And then you can go back and just go back to the previous slides and look at those numbers for the variable and the fixed. So for the variable, we had indirect material, labor, and variable utilities. We can add those up. We get $250. And then for the fixed overhead, if you look at the total, it was $30,000 per month. And again, if this is for the year, that's going to be $360,000. And then you'd have to divide by some sort of production volume. You'd have to know how many units you're going to produce. And in this case, if it's 400,000, what you simply do is just take your total fixed, divide by that budgeted production. That's going to break that down to a cost per unit. And then you could just basically add up all your product costs to come up with a cost per unit. Now, the reason you'd want to do this is because on the next slide, we'll look at a budgeted income statement. Essentially, this is how you can figure out your cost of goods sold. As long as you know how many units you're selling and what the cost is for each unit, you can basically just take your unit sales and multiply by this $12, and that's going to give you your projected cost of goods sold. So again, if you look at this budgeted income statement, notice you've got your sales revenue. There's your budgeted sales revenue from your sales budget. Notice to get cost of goods sold, again, this is for the month of January. If they sell 30,000 cases and it costs about $12 per case, that's going to give you cost of goods sold of $360. So then that gives you gross profit of $240. And then go back and look at the previous slide. You can link in your operating expenses. Here's your period costs. Remember, you subtract out your period cost. That's going to give you operating income. And of course, in this case, they're going to tell you that the tax rate is 35%. You just have to take 35%, multiply that by 97.2, and that's going to give you your estimated tax. And then bottom line net income would be $63,180. All right, so let's look at this illustration on a budgeted income statement. Notice we've got Bell Simpson makes a specialty precision scale. It says they expect to sell 800 scales at an average price of $2,350 per unit. Again, this is for the month of January. They go ahead and give you the cost to make for each scale is $1,400, so that's going to essentially be our cost of goods sold. They tell you the variable operating, so this is going to be your period cost of $1.10 per unit sold. and fixed are 7,700 for the month. They give you some interest expense. That's another period cost. They tell you a tax rate of 40%. So in the next slide, we're going to put together this budgeted income statement using this data. So again, notice pretty simple. They told you 800 sales units multiplied by the sales price of 2350. So here's our sales revenue. They told you that the cost, this is your cost of goods sold for each unit, is 1400. Multiply that by your units sold. So here's your cost of goods sold. You're going to subtract that from sales. You get gross profit of 760,000. So everything below gross profit now is going to be your period cost. So you got variable and fixed. The variable part of it would be 800 times $1.10 plus that fixed is 7,700. So you're going to again subtract that. That gives you operating income of 751,420. You multiply that, or sorry, let's do the tax at the end. Sorry, there's interest expense. I almost forgot. You subtract out the interest expense. That's one of those other line items. Then that gives you your income before tax. And then of course, you would then take 751,420, subtract the 3,700, and they're going to show you this calculation right down here below. They take times that 40%. That essentially is your income taxes. You then subtract that. It's going to give you your net income of 448,632. Okay, so looking at objective 3 is we're going to look at the other financial budgets. Okay, so when we're talking about these other financial types of budget components, we can look at what they call capital expenditures. These are kind of like your big ticket purchase items, like you're buying equipment or land or buildings or other companies. You also have a cash collections and cash payments. I typically tie these into simply, combine these. You're going to call it a cash budget where you look at cash in and cash out. And then the final thing is you can also put together a budgeted balance sheet. Okay, so notice on this illustration of a capital expenditures, and so they give you some month. Notice what they're buying: computers, printers, delivery vans, production items. Again, these are big cost type of items. They call these capital expenditures. And for this particular problem, all you do is they don't have anything in February or March. They only have these in January. You simply just add it up, and that would be your total cost for your capital expenditures. In this case, it'd be 125,000. So then you can look at a cash collections budget. Remember, cash collections is always based on sales. Notice it's always from your sales budget. And if you go back to the first slide where they told you how much of your sales is cash and how much is credit, you would need to know that. So, for example, to figure out how much cash is coming in for the month of January, you need to know how much your January sales are cash and how much of those are credit. And in this case, and lots of times you have to actually go back and look at what happened in December. So if you look down here, for example, at the calculation for January to figure out cash collections on credit sales, notice it says 85% of December credit sales, which they're telling you is 500,000. So you're actually looking back 1 month. In this case, you're collecting 85% of December. And then it even said you had to go back 2 months because you had 14% of November's, which was 480. So in that case, you'd multiply that by whatever November's sales were, and then you could add these together, and that would also help you figure out your cash collections for the month of January. Now, one thing that's kind of left out on this particular illustration that lots of times you have is, don't forget, if you have any cash sales, you would also need to include that, which they didn't in this illustration. But if they tell you that there are some cash sales, don't forget you would also need to put that in here because you're actually collecting it. Okay, so let's look at this illustration. We've got sales revenue over a 5-month period, November through March. They tell you that the company sales are 20% cash, 80% credit. Its collection history indicates that credit sales are collected as follows. So here's basically, it's 30% in the same month, 60% next month, 6% 2 months later, 4% are never collected. You actually don't have to even worry about that one because we're only interested in collections, not non-collections. Question says, how much cash will be collected in January, February, and March? So we'll show you this in the next slide. Okay, so let's look at this calculation on your cash collections. Notice we've got January, February, March. And so notice on the cash sales, if you go back and look at the January sales, for example, was 15,500. They told you that it was 20% cash, 80% credit. So if you multiply 20% by the January sales, that would give you that 3,100. So then the collection on the credit sales, then you have to follow their collection history. And like I said before, you don't have to worry about that 4% of non-collection. You're only worried about what's being collected. So you also need to say, okay, 30% in the month of sale. So essentially, you'd have had to have taken 15,500 multiply that by 80% because 80% of that is credit, and then multiply that by 30% because that's how much of that's collected in the month of January. That's how they're going to come up with that 3720. So then when they say 60% in the month following the sale, so this is where you actually have to go back and actually look at December. So you have to take the December number. Remember, here's the thing. December number, first multiply December sales first by 80% because you have to convert it to the credit sales, and then multiply that by 60%, and then that should give you the 5,040. So then it says 6% 2 months later. Then you have to go back to November. Remember, you have to actually look back 2 months, look at November's numbers, multiply November's sales again first by 80%, that's the credit part of it, and then multiply that by 6%, and that'll tell you how much cash is going to be coming in the month of January. So if you add in your cash collections on the credit sales plus the actual cash sales for January, gives you total projected collections for the month of January. So then here's the trick. Just remember, any month you're looking at, you always have to look back 2 months, all right? So for January, you had to go back to November. So if I go to February, you need to basically look back to January and to December to get all of these numbers. So all of these numbers are basically based on February. So this number would be February. You then go back to January, and then you go back to December to get those prior 2 months to get your cash collections for the month of February. Don't forget, before you can do the collections, you have to convert it to how much of their sales are credit first, and the problem told you it was 80%. Okay, here's an illustration on a cash payment budget schedule. And again, all these numbers here where they tell you cash payments for material purchases, labor, overhead, all these things would be pulled from all of your other budgets that you've already actually prepared. You just have to go back to your other schedules that we've already done and simply say how much of those were we going to be paying in whatever month. So remember, this budget would simply be linked to your other schedules you've already prepared. Same with your income taxes. Any dividends would have to be given in the problem. And this would be giving you your total cash payments for this particular quarter. Okay, so if you look at this illustration, you got 9-11. They want a cash payment budget for the next month. They give you all the informations in letters A through E. So for example, letter A, they tell you about they pay 55% of its direct material purchases in the month of purchases and the remainder in the following month. They tell you what the purchases were. It says last month's purchases were 79,000, while it anticipates 88,000 of purchases for the next month. So we'll need this ratio, 55% of direct material purchases in the month, and therefore it would be 45% would be in the next month. They tell you the direct labor is budgeted to be 35,000, will be paid at the end of the upcoming month. They tell you overhead is estimated to be 140% of direct labor cost each month and is paid in the month in which it incurred. They tell you that the monthly estimate includes 11,000 of depreciation. The reason they tell you that is because remember, depreciation is non-cash, so you're going to have to take out that part. You don't need depreciation because that's non-cash. They then tell you that the operating expenses for the next month are expected to be 46,000. They include again 2,000 of depreciation on office equipment and $1,400 of bad debts expense. They're telling you this because these are non-cash items, so you don't need those. It says these monthly operating expenses are paid during the month in which they are incurred. Finally, they tell you that they're going to make some tax payments of $7,600 for the next month. How much? The question is how much cash will be paid next month. Okay, so here's how you'd get your cash payments. So to start with, to get your cash payments for your purchases, let me show you how they got these numbers. So what they would have done is they would have taken 88,000, that was the next month, multiply that by 55%, that would give you for the next month. And then from the previous month, they told you it was 79,000 of purchases. You'd multiply that essentially by 45%. So that's how they would have come up with these two numbers for your cash payments. That would be for just your materials. Now, cash payments for labor, they just gave you that. It says you paid it as it is incurred in the month. So there's 35,000. They told you that for the overhead, it was 140% of direct labor cost. So what you do is you take the 35,000, multiply that by 1.4, and then once you do that though, they told you that some of that includes depreciation, so then you have to subtract out $11,000 of non-cash expense. That would be the 38,000. And then for the operating, they told you it was 46,000, and then they said it included depreciation and bad debts expense, so you have to subtract out the depreciation because remember that's non-cash. and then also subtract out your bad debts expense, because if you remember from financial accounting, that's also a non-cash item. That would be your operating expenses. And then for the taxes, they just told you the number is $7,600. You add all these up, this would be your total cash payments for the month. And then you'll notice once you've done all these, at this point, to do your combined cash budget, you just have to go back to the previous slides and simply just pull everything in. So you'd have all these months. You go back to the cash collections for each month that you would have prepared. Notice you take any beginning cash balance, that's your starting point. You're going to add cash collections. You then subtract out all of your cash payments. Again, these would have been pulled in from a different schedule. That's going to tell you what your projected ending cash balance is. You need to know this just in case you have to borrow. So in this illustration, they're telling you they want you to borrow $20,000 for January. You add that to your negative cash balance. This gives you a projection of what you're going to have in January. And then notice this balance then carries over to the beginning of the next month. And you basically just do the same calculations. It's pretty simple. You add cash in, you subtract cash out, and then of course if there's any interest or repayments, they'd have to tell you that in the problem. You'd put that in the appropriate month. The goal would be to come up with an ending cash balance at the end of the month and also at the end of the quarter. And then finally, you can do your budgeted balance sheet. And again, this is pulled in from all of your other budgets. Notice they give you cash from the cash budget, accounts receivable, net of allowance. Again, this is stuff they would have given you extra. They didn't tell you earlier, but they would have given this to you. Notice all of your other stuff, raw materials, finished goods, any sort of prepaid taxes. Again, information you can either pull from your other budgets, or they're going to tell you this in the problem. Property, plant, and equipment, that's going to be, of course, from your capital budget and anything else you have on hand. Again, your balance sheet is your balance sheet. You add those up, that's your total assets. Any sort of liabilities, again, pulled from either your schedules or just given in the problem. So you have to add up your liabilities and your equity. And again, just like any balance sheet, you'd have to balance assets should equal liabilities plus your equity. Okay, so once you've actually prepared all of your budgets, then of course you're always asking the question of what if. They refer to this as sensitivity analysis. What if, for example, a result will be if a predicted amount is not achieved? What if you don't get the results? Or what if you change an assumption? What if you change a variable cost or the sales price? Or what if you change your sales units? What if there's a new law that's been enacted by Congress that could have impacts on your sales? So sometimes you may have to do some revisions of your original budget, make some assumptions, make some revised budgets, because remember, lots of times your initial budget, when you actually compare it to the actual results that actually happen, very rarely is it ever going to be close or even the same. So that's basically called the sensitivity analysis. You're doing your what if analysis. Okay, so the last thing for objective 4 is to walk you through the same type of budgets, but not for a manufacturer, but to show you how they would look like for a merchandiser. And for the most part, everything's going to be very similar. You'll see that in the upcoming slides. And so, for example, you also can do budgets for a service type of company. Now remember, if you're doing it for service types of companies, you don't have inventory, so you're not going to have to worry about the raw materials type of purchases or direct materials, but you'll still have labor requirements, you'll still have overhead, you'll still have operating expenses. So all that's basically going to be the same, most of it, but just remember the one big difference is if you're not doing manufacturing, you don't have to worry about like an inventory type of budget. Notice again for merchandising companies, it's essentially the same thing. The budgets, the financial budgets are the same. Your cost of goods sold is going to be whatever the inventory you're buying it at. So notice, but essentially you still have sales, you still look at cost of sales, you look at your period cost, you still do the same essential budgeted financial statements. Look at the inventory formula. It's essentially the same, but you take your cost of goods sold, you add desired inventory like we did before, you get total needs, you subtract out the beginning inventory, is going to give you your required purchases of your merchandise. And if you look at this particular illustration, they're doing a purchase budget for a merchandiser. Notice the starting point is your budgeted sales revenue. Then they've got your cost of goods sold. So somewhere in the problem, they're going to have to give you what the cost of goods sold percentage or what it's going to be based on sales. In this case, it looks like it's 60% of sales, or 30% of sales, or 60% of sales for January. So cost of goods sold is $300,000, and they give you that kind of down here below where they're telling you that it's essentially 60%. And so once you know cost of goods sold, in this particular problem, their ending inventory requirement is 10%. So just like we did before to get the ending inventory, if you're in January, You take 10% of February's cost of goods sold, which is 312. You get 31,200. You're going to add that to cost of goods sold. That's going to be your total inventory requirement. You then subtract out the beginning. Now remember, the beginning is essentially 10% of the 300,000, and that would give you your inventory that you would need to budget to purchase just for the month of January, and you would just follow this same process for each month.